Hope everybody has had a great time. I find this facility wonderful and the food at the various restaurants even better. I'd be a little higher weight on the airplane going back from Fort Myers, I think, if you all know what I mean. Hope everyone enjoyed our speakers yesterday. We were just sitting down here having breakfast talking about Dr. Hainig and some of the others and how much we learned from them. And Ballard was saying he saw Hainig on television twice this morning already, but that's the quality speaker that the Bankers Association brings to you. We also want to thank Abrigo for sponsoring our breakfast and Car Rigs and Ingram CPAs for the coffee station. We talked yesterday about getting us caffeinated in the morning gets us going. I know you're eager to hear from our first speaker this morning, so I'll shut up for a minute and we'll get right to it. Dr. Lindsey Piegza is the Chief Economist for Stifel Financial. She specializes in the research and analysis of economic trends and activity, world economies, financial markets, monetary policy, and fiscal policies. Prior to her role with Stifel, she was a Senior Economist for an investment bank in New York City for 8 years, consulting clients in the U.S., Europe, Africa, and the Middle East and Asia. A highly sought-after speaker, as you might imagine, across national and international forums. Pieza is often quoted in the business press. She's a regular on CNBC, Bloomberg, CNN, and Fox Business, as well as national radio and business news outlets. Pieza is also a monthly op-ed contributor for The Hill. Welcome, Dr. Pieza.
Well, good morning, everyone, and welcome. Let me start by thanking you for joining me here this morning and giving me this opportunity to present on the state of the U.S. economy. Now, with all this volatility that we've seen in terms of the market, in terms of the data, in terms of expectations of investors, it's understandable that there are a number of questions that we're facing right now. Are we in recession? How deep and how pronounced will the downturn be? Has inflation peaked? When will it peak? And what is the Fed going to do about all of this? But before we get into that, I do want to start on a more positive note by taking a look at the labor market. Because while other sectors of the economy are clearly showing signs of waning momentum, arguably we can check the recessionary box for most of these other sectors, the labor market, well, that's not the case. The labor market, we continue to see very strong, robust job creation on a month-to-month basis. We added over 300,000 jobs last month. Now, this was a slower pace than the over 500,000 increase that we saw the month prior, but still, when we smooth out that volatility, we continue to see nearly 400,000 Americans return to a position of gainful employment on a month-to-month basis. And in fact, we see further improvement in the labor market looking at the unemployment rate, currently at 3.7%. Not only is this a stark improvement from that peak of near 15% at the onset of the crisis, but look at where we are in relation to what the Fed designates as the full employment range. We're not in the full employment range. We're now even below the lower bound of that full employment range. But to be fair, the headline decline, while impressive, does show two different themes in the labor market. On the one hand, yes, we are putting Americans back into a position, as I mentioned, of gainful employment, but that steep decline also reflects the fact that millions of Americans are on the sidelines, no longer participating in the labor market. And the way we calculate unemployment in this country, you have to be actively seeking a job to be counted as unemployed. So essentially, it's very easy to get the unemployment rate down to 0 if nobody's looking for work. But it's not necessarily then indicative of a solid labor market. Now, going forward, as more workers slowly move back into the labor market, we would then expect the opposite to occur, upward pressure on the unemployment rate. at least in the near term, as more potential workers are seeking gainful employment. And this is exactly what we saw last month. We saw that uptick, as you can see, all the way to the right-hand side of the chart, 3.5 up to 3.7%. So it's maybe a little counterintuitive, but if in fact we continue to see a rise in the unemployment, at least near term, this may be a positive indication for labor market conditions if in fact that rise in the jobless rate reflects the fact that sideline workers are now moving into the labor market and seeking employment. So along with that rise in the unemployment rate, we also saw last month an uptick in the participation rate, as nearly 800,000 workers moved back into the labor market, now seeking a position of employment. Now, as you look to the right-hand side of the chart, you can see that little bit of improvement. But broadly speaking, there's still a sizable gap between where we are today and where we were prior to the pandemic in terms of participation. So I think it's fair to say that businesses are still very desperate for workers at this point. And this continues then to put upward pressure on compensation. Now, first and foremost, businesses are trying to extend the work week of existing employees. They're also trying to incentivize new workers to come on board by offering maybe better health benefits, maybe childcare services, maybe even happy hours or pizza parties on Friday. But they're also resorting to a rise in traditional compensation metrics. So as expected, wage pressures are on the rise, up over 5% on an annual basis. Although I would argue, as we look to the latest data points, we're continuing to see volatility, but it does appear that that momentum has flatlined somewhat, as at least some businesses are now beginning to struggle greatly as costs continue to become more elevated. Everything from rental costs to labor costs to parts and materials costs. Now, in the longer run, an ongoing increase in wages, or even maintaining this elevated level, will continue to be a sizable burden for businesses. Smaller businesses in particular are having a very difficult time shouldering that cost increase. And so as we continue to see these elevated levels of prices, we would anticipate a reduction in hiring, investment, or many of these businesses forced to close their doors. On the flip side, some of these larger businesses that maybe are better able to shoulder those cost increases, we've already seen a trend moving away from that costly labor input, resorting to technology where possible. Now, to be fair, this was a theme that we were already seeing in the US economy prior to the pandemic, but the pandemic, elevated labor costs have simply accelerated that pathway. Think about ordering from an iPad, downloading a QR code, self-checkout. These are factors that we were already seeing businesses adopt and adapt to in order to compensate for those higher costs elsewhere. But I think the takeaway, or the bare minimum in terms of looking at the latest labor market data, is that even here, the silver lining of the economy at this point is beginning to show some cracks, beginning to show some indications of waning momentum in the jobs market. And I would say, to put this in a different perspective, because we just talked about the robust job creation that we're seeing, but maybe from a different perspective, let's look at this relative to where we would have been without the pandemic. Because remember, we lost 22 million jobs as a result of the COVID shutdown. And only as of July did we recapture those 22 million jobs. So when we talk about this robust job creation on a month-to-month basis, well, maybe it's less about job creation and more about job recapturing. Because in fact, look at that dark blue line. That's essentially where we would have been without the COVID crisis. So we've just recently, again, as of July, clawed ourselves back to where we were, let alone talk about creating new jobs above and beyond that baseline over the past 18 months to 2 years. And so looking at the potential growth that we would have expected in the labor market, we're still millions shy of where we should be. So putting it in that picture, in that light, maybe the labor market is noticeably less robust than we previously thought. And improvements in the labor market, we also have to remember, are far from even across all sectors. Some of the hardest hit industries still struggling to reconnect with employees, customers, supply chains. Looking all the way to the left-hand side of the chart, you can see leisure and hospitality. This is one of the hardest hit sectors. We've lost over 8 million jobs, but we've since clawed back only about 6.5 million. By stark contrast, however, look at business services, a recapture rate of 146%, the highest in the marketplace. Why? This was one of the industries most easily adaptable to the COVID safety protocols, the work from home environment. Other industries, looking to the left again, not quite as lucky. So we're still seeing a lot of unevenness as well. Even though we have recaptured the nominal level of 22 million jobs, many sectors are still facing a sizable deficit of labor. And it's not for a lack of trying. Many of these hardest hit industries are desperately trying to hire at this point. It's not a lack of job openings, job opportunities. It's a lack of able and willing bodies to come back into the marketplace and fill those job vacancies. Looking here at what we call the JOLTS survey, or the Job Openings and Labor Turnover Survey, you can see we have nearly 11 million job openings in the marketplace at this point. Now, arguably, yes, it does appear as if we've peaked and we've come slightly off those peak levels, but we're still talking about historically a significantly elevated number of job vacancies out in the marketplace, as labor demand is far outpacing labor supply. Now, along with those 11 million job vacancies, we also know that there's roughly 6 million Americans currently reporting a position of unemployment. So I think one of the questions that I hope some of you are asking yourselves right now is, what's causing such a sizable labor supply gap? What's causing this mismatch? Or essentially, where have all the workers gone? Now, this has been dubbed the Great Resignation, but why? Is it baby boomers retiring early for fear of getting or spreading the virus? Is it Gen Zers or Gen Xers, the younger workers, sitting on the sidelines, still waiting for higher compensation, more flexibility, additional incentives, happy hours, etc.? Or is it working families seeking increased flexibility for more of a work-life balance or work-kid balance? Well, it's certainly not an easy answer. It's not a one-word answer by any means. So I think when we're talking about what's causing this, it's all of the above. There's a number of different themes that are driving workers to the sidelines. Now, first and foremost, as you might imagine, in the aftermath of a global pandemic, some workers do have, understandably, lingering health concerns or ongoing health impacts as the result of the virus. Think of the so-called long haulers. We also have lingering childcare or elder care issues that are impacting working families, and in particular, let's be honest, working women. Now, with schools back reopened, this has alleviated a good amount of pressure on those caring for school-aged children. But what about the families that are caring for an elderly family member or a child not yet of school age? Well, in many cases now, we're talking about nursing home facilities, daycare facilities, closing or operating at reduced capacity, as many of these institutions are reportedly facing staffing issues themselves. So now it's less about the virus, less about COVID, less of a health perspective, and more of the growing impact of a lack of labor force participation, a lack of workers out in the marketplace. And of course, third, we know there's been numerous studies that have indicated that earlier fiscal policy measures did, and in many cases still are, having an impact, a negative impact on growing the pool of potential labor by essentially creating an incentive to remain on the sideline, both near term and longer term, as many individuals were able to accumulate a sizable amount of savings. Now, going forward, we do expect this labor supply gap to be potentially reduced. As schools are now reopened, fiscal stimulus has ended, vaccination rates rise, caseloads decline, a general fear of the virus appears to be subsiding. But for many individuals, the sense of immediacy to return to the labor market is simply not there, because we're still eating through that enormous wealth cushion that was accumulated during the pandemic. We estimate that because of all of these stimulus measures and the nominal changes in how we work, spend, commute, live, there was a wealth cushion built up around $6 trillion. Now, I'm certainly not implying that that will continue to support millions of workers indefinitely. It won't. Already, we've seen the savings rate decline markedly, and we estimate that about 85 to 95% of that wealth cushion has already eroded. So that money has already been spent. But that does still leave a good amount of wealth out there in the marketplace to continue to support millions of potential workers, maybe for another month, maybe for another 2, 3, at which point many are hopeful there'll be additional fiscal initiatives to help support those in a position of hardship or those still reporting a position of unemployment. Already more than a dozen states or major cities have initiated new fiscal support measures, stimulus measures, to help the populace reporting a position of hardship or, again, still a position of unemployment. But for others, the impact of a declining wealth cushion or this notion of a reduced or evaporated wealth cushion is already having an impact on consumer behavior. Now, I've circled January. That's where we were at the start of the year. That outsized rise in retail sales or retail spending really offering an indication of this potential resilience of the consumer. But since that outsized rise at the start of the year, you've seen the weakness continue and intensify as consumers are very dramatically changing their behavior. Now, for some, this means spending less outright. For others, this means maybe reducing the quality of their purchases. Instead of buying premium shampoo, maybe you're now buying Walgreens brand shampoo. And for others, particularly the younger generations, what we're seeing is something deemed binge spending, where consumers will pull back to the absolute bare minimum for 1, 2, maybe even 3 months in order to still buy that larger ticket, more expensive item in month 4. But regardless of the form that it's taking, what we're seeing is that consumers are dramatically shifting the goods and services in their basket month to month, something that we do, something consumers do when we're increasingly concerned about our financial footing. Already we've heard from a number of large retailers pointing out this change in consumer behavior, suggesting that the household balance sheet is becoming increasingly fragile as costs continue to rise and inflation continues to eat into the average American's ability or ability to spend or purchasing power out in the marketplace. And I want to show you what happens to the consumer picture when we account for those price increases. Because a lot of times we look at retail sales not adjusted for inflation. We look at those nominal spending levels not adjusted for inflation. And so when we actually take into account that rise in prices, now think back, earlier I was talking about 5% wage gains, which sounded pretty good. But against the backdrop of 6, 7, 8% inflation, all of a sudden that 5% wage increase isn't that impressive. And when we account for price increases, look at that light blue line, we've been in negative territory, negative real income growth for the better part of the past year. Real consumer spending, the darker line on top, still in positive territory. We're still out there spending, but now we're spending at a much reduced pace, around 2%, down from the average, as you see that red line, of about 8% last year, and of course even further below that peak level, that double-digit growth level that we saw as we emerged from the pandemic. But of course, even with spending down on a relative basis, it is still positive. Consumers are still out in the marketplace demanding goods and services, and that's continuing to keep pressure on producers, to keep production positive as well. And you can see here, looking at the ISM, this is just a gauge of national manufacturing activity, you can see that run-up to the opening of the economy, businesses trying to get back online. Now, since then, just like the consumer, we've lost a considerable amount of momentum, but we're still in positive territory. I should mention this is a diffusion index, which simply means above 50 is expansion, below 50 is contraction. So you can see that activity, again, well off peak levels, is still in that expansionary portion of the chart. By contrast, however, let's look at the light blue line. That's Chinese manufacturing, falling back into negative territory, arguably as expected, amid the latest round shutdowns. So when we ask the question, or when I'm asked the question, when will these supply chain dislocations become a thing of the past? When can we stop talking about them? Well, much of the answer depends on the global policy response, not just to COVID and the next variant to inevitably emerge, but the next virus to inevitably emerge. With much of the emerging world still engaged in very strict COVID policies, including China's zero COVID policies, I think the idea of getting back to the free flow of goods and services is still several years out. Now, that's not to say we won't make incremental progress along the way, but getting back to that fluidity of the global exchange of goods and services across country lines, I think that's still a distant goal sometime in the future, if we ever return to that full level of fluidity. Now, turning the page to the housing market for a second, shifting gears here, just like the labor market, one of the key supports to economic growth, housing too had been a very positive sector for economic activity, with sales surging near 20% at the start of the year as Americans were flooding into the housing market during the pandemic and in the immediate aftermath. More recently, however, amid rising interest rates, so rising borrowing costs, higher prices, a lack of access to parts, materials, labor, negative real income growth, all of these factors now have dampened demand. And we've seen a very steep, again, just like the consumer, just like production, this steep loss of momentum. Still positive, so we're still talking about this second derivative decline, a slower pace of still positive sales. But you can see a very steep contrast to what we saw in the immediate aftermath of the pandemic. Now, demand has softened, so we're coming off of peak levels, and some sellers anxious to offload their homes in a hot market have jumped in. And so inventories are off of lows, but we're still talking about a sizable gap between demand and supply. And as long as demand is outpacing the level of supply in the marketplace, we continue to see a positive growth profile in terms of prices. And that's exactly what we're seeing. Looking here, if you can find that light blue line, that's the 20-city index. So this is home prices in the largest 20 cities across the country. And prices are still up about 20%. Now find the dark blue line. That's the national home price index, also up 20%. What's interesting about that is look to the previous cycles where the housing market is gaining significant momentum. Typically, it's that light blue line, the 20 cities that outpace the rest of the country. Think about the traditional hot downtown markets, New York City, LA. No, this time around, it wasn't just segmented to those hot urban areas. This time around, we saw double-digit price growth in what we would consider secondary or even tertiary housing markets. It wasn't just New York City, it was Rochester, New York. It wasn't just Boston, Massachusetts, it was Peabody, Massachusetts. Not just downtown Denver, but Fort Collins, Colorado. And so what this tells us is it's less of a bubble-like scenario in today's housing market and more a reflection of what I would argue is a change in structural preferences as individuals relocated from one city to the next or from one city to a more urban area, more suburban area. Remember, people were fleeing the cities for safety. They were looking for less expensive alternatives. They wanted more space to accommodate that new home office. They were taking advantage of record low interest rates while they last, or this new work from anywhere environment. So there were a lot of different factors driving that price growth relative to some of the previous housing market cycles that we had seen. So what does all of this mean from a policy perspective? Well, uncertainty in the data, unevenness in the outlook, this is the perfect environment for those in Washington to continue to push for further fiscal initiatives, all in the name of American competitiveness, job creation, and reducing inflation, despite potential inflationary implications. And that's exactly what we saw from the Biden administration. After months of negotiations, the White House was successful in passing a $1.2 trillion infrastructure bill. And more recently, at the bargain price tag of just under $450 billion, we now have the IRA, or the Inflation Reduction Act. Now, depending on if you're opposed or you support the package, there's very different views on the Inflation Reduction Act. Let's look at the bipartisan analysis, so we leave politics out of this. It is concluded that the IRA will have a positive impact on reducing the deficit 10 years from now, and as a result, potentially have a minimal downward effect on inflation. Again, 10 years out. In the near term, however, the data does suggest that there could be upward pressure on near-term inflationary pressures. So really at odds with what we're seeing in terms of monetary policy. So when we talk about what is the connection with the IRA and inflation reduction, it really does seem to be in name only, unfortunately. But I get it, with November elections around the corner, legislation that could potentially reduce the deficit 10 years from now and by extension maybe have a minimal impact on inflation 10 years out while potentially increasing inflation near term, it doesn't roll off the tongue as easy as Inflation Reduction Act. So I think just from a name standpoint, I get it. It made a lot more sense to name it the IRA. And I pick on our politicians in Washington, but it wasn't just here in the US. We saw a massive fiscal initiative across the developed world. You can see, however, the spending in US was more than double the next largest spender. So really an incredible growth in the government's balance sheet, in the government's initiative to try to stem the impact of COVID and the policies related to COVID. In total, however, as I mentioned, everyone, or most developed countries following suit, in total, the developed world spent $17 trillion to combat the impact of COVID. And so as a result, what we see is that nearly all of these developed countries are reeling from inflationary pressures, predominantly stemming from the supply side of the equation. But here in the US, as you can see, inflation is significantly above anywhere else in the developed world because not only do we have the same supply side pressures, but because, whether or not justified or not, because we saw such a massive fiscal initiative, we also have the demand side of the inflation equation coming together to result in even higher pressures, nearly double what we're seeing in other OECD countries. So what does this mean for the Fed? What does this mean for monetary policy? Well, for the Fed, again, uncertainty, unevenness in the data continued to support the Fed on the sideline for nearly 2 years. However, in March, the Fed took a markedly more hawkish position, raising rates 25 basis points, opting to double that to 50 basis points in May. And of course, we're now poised for our third round 75 basis point increase later this week. I know we're all on the edge of our seats for that. But what you can see by this chart, even before we see this week's announcement, is the market increase in expectations for Federal Reserve policy. Back in March, the light blue line, the Fed anticipated a much more benign inflationary profile, and thus by extension, a much more benign pathway for Fed funds, reaching a terminal rate of about 2.5%. By June, with inflation stubbornly high, the Fed raised that to nearly 3.75%. And amid more hawkish language as of late, we do expect a further increase in expectations, again, later this week as we receive not only the latest policy decision, but an updated version of the Summary of Economic Projections, or the SEP. But it is important to remember that there still is a wide array of opinions among Fed officials. Some less convinced that we will need to go quite as high as some of the more vocal Fed members have been out in the marketplace. But even if the committee is not of one mind of where the longer run pathway for rates is headed, they are of one mind in terms of what's driving those policy decisions. And that's in still too high or still elevated level of inflation. And whether your preferred inflation metric is the CPI, the PPI, or maybe this is more of a PCE group, again, regardless of the measure that you're watching, prices are extremely elevated. And we're feeling that as bankers, as investors, as consumers, as business owners, every time we go to the grocery store, every time we fill up the family car. And in fact, in many of these key categories, we're seeing multi-decade highs in terms of prices, with an upside risk, arguably still very present in the marketplace amid ongoing international conflict and still very strict, as I mentioned earlier, safety protocols in much of the developing world. Our prices were already on the rise in the aftermath of COVID-19, but international conflict simply exacerbated that upward trend. Now you're saying, wait a minute, Lindsey, all the way to the right-hand side of the chart, commodity prices have come down precipitously. Absolutely. Welcomed reprieve. But they're still up relative to 1 year prior. Wheat prices up about 5–6%, energy prices, let's call it 8–9%. And much of the damage has already been done. Think about those price increases in terms of commodities impacting staples like bread, flour, pasta. These are staples that many countries rely on to feed their populace. And these costs are already up 10 to 20%, depending on where you are in the world. So much of those cost increases have already been baked in. And so while we talk about gasoline prices here at home as potentially the fastest way to derail the American consumer, I would argue the bigger risk, at least from a global standpoint, is further disruption to the agriculture market, the international agriculture market. Developed countries can sit around and try to find alternatives to Russian crude, but there is no OPEC to global food supply. When supply falls short, people go hungry. So with all of this as a backdrop, the Federal Reserve has signaled a willingness to root out inflation no matter the cost. The question is, will it work? Well, typically the Fed is raising rates when the economy is overheating. This time around, the economy is not overheating. We're already in negative territory. And to complicate the process, as I mentioned, a lot of the supply side inflation is leading the pressure. So the Fed can raise rates, raise borrowing costs to tap down demand, tap down consumption. That will lead to a slower level of growth and a slower level of inflation. But how does raising borrowing costs address supply side constraints? How does that ease pressures from China's zero COVID policy? Arguably, it will have no impact. So again, complicating the picture for the Fed and ensuring that if the Fed does continue along this more aggressive pathway, we will see a further loss of momentum or an outright recession. Now, I'm sure many of you are very intrigued by this conversation going on in the market right now. Are we in a technical recession? I would argue that this conversation is really moot at this point. For the average American, the average small business struggling, it doesn't matter if we call it a recession, a downturn, or as Alan Greenspan once said, it's not a recession, it's a cumulative unwinding of economic activity. Regardless of what we call it, hardship is hardship. And so again, the conversation of are we in a technical recession, what's clear is that the economy is losing momentum in every category across the line, save for the labor market. The jobless rate, even with an uptick to 3.7%, has not and does not indicate a sizable loss of employment, typically a prerequisite for a technical declaration of recession. So the bigger question is, does the Fed have the resolve to continue to raise rates as weakness compounds, or it's finally determined that we are in a technical recession? The Fed seems to say yes, but up until recently, the market was saying a very clear no, pushing back against the Fed. But as we saw two less than cool inflation reports, and against the backdrop of very hawkish rhetoric from the chairman suggesting that not only will it be a possibility of seeing negative growth, but it's a necessity to see a long-term or prolonged period of pain, to use his words, pain for businesses and households, did the market begin to buy into the Fed's more hawkish tone. So what does this mean for rates? Well, as the Fed continues to raise rates, we do expect the short end to follow along with the Fed. The longer end, however, as we've seen, even with this steep upward trend, the long end will struggle to keep up with the Fed as policy intentionally slows us into a downturn or a technical recession. So from a forecasting standpoint, it's less important about pinpointing the exact nominal level of rates and more important to understand the directional momentum and the factors driving that momentum in one direction or the other. And we can certainly talk more about these scenarios in just a bit. Also, keep in mind that we do have the balance sheet as well. Not a primary focus right now. The market is primarily focused on rate increases, but this will likely provide, I hesitate to say upward momentum, but perhaps a floor to longer term rates. At this point, the only certainty is continued uncertainty in the marketplace. As Chairman Powell said, it's very difficult to forecast in a market under the best conditions. But in today's market, with unprecedented volatility, unprecedented uncertainty, it's virtually impossible. And keep in mind that it's not just economic forces that are driving this volatility. We have international conflict, international policy, the threat of geopolitical conflict in the Asia-Pacific region, all of these factors, not fiscal policy as well, as we talked about, conflicting with the directional intentions of monetary policy. All of these factors further complicating the economic picture and the economic outlook, making it a very difficult environment for us as bankers, for us as business owners, and very painful for us just as ordinary citizens and consumers. And on that happy note, I think we will turn it over to the panel now to engage in some lively Q&A.
Well, thank you for joining.
How does a bank budget for the coming year? The support and guidance of Compliance Alliance's team and tools reach every part of your financial institution, just like the federal regulatory requirements do. By sharing these costs across the entire organization, CA is more affordable than you may think. Discover how to budget for compliance in the coming year by speaking to our team at 833-683-0701 or by sending us an email, info@bankersalliance.org.
That was a lot to take in, but I have a quick question for you.
Yes.
You mentioned the supply chain solution may be several years off, and zero COVID in China having part to do with that and that sort of thing. The very basic definition of inflation is when demand exceeds supply. Do you see this a long-term inflationary curve because of the supply chain issue?
I think it certainly complicates the timeline to ease those inflationary pressures. Again, the Fed is going to focus primarily on the demand side. But if we continue to see supply chain constraints, limitations, disruptions to global trade, that will leave us at an elevated baseline of inflation that the Fed may not be able to break through with traditional monetary policy metrics. Now, there are some initiatives that fiscal officers can take, maybe easing some red tape in terms of distribution, transportation of goods, easing red tape at the ports to receive goods. But I think that might be more politically difficult to initiate. I also think that we could see some business decisions being made as a result of these ongoing supply chain constraints. Maybe businesses come back to the US, maybe they relocate production out of these areas that continue to face these limitations. But again, these are not easy solutions. These are more midterm to longer term solutions. In the near term, I do see these supply chain constraints continuing to provide a floor to inflation.
A year ago, we were hearing the word transitory.
Yes.
Paul Krugman, who I think everyone would agree is a liberal economist, but a Nobel-winning economist, was saying transitory inflation. A speaker we had here last year, very conservative economist, said, I hate myself when I agree with Krugman, but it's transitory. What happened?
Well, I think the Fed initially was correct in their assessment of transitory price pressures if the assumptions that they had made had carried forward. If the impact of COVID had been temporary, if the impact of the shutdowns had been temporary, if we had returned to reopening the economies globally, so worldwide, I do think we would have seen more of a transitory impact. But because of the length and the depth of the dislocations, particularly on the supply side, it was very clear that this was no longer transitory, that this was becoming broad-based. And even after we started to see—
I think that's accepted now.
Absolutely, but it's a little too late. Now price increases are broad-based, and the Fed is struggling to catch up. They're arguably behind the curve. Now, I think one of the questions is, why did that matter if it was transitory or broad-based? How would that have impacted policy? The idea is that the Fed does not want to make longer-term policy decisions based on a temporary blip in prices. And that's why we look at something called the core inflation, because we strip out food and energy, which tend to be the most volatile components. So if there's a weather event in Venezuela that wipes out the coffee crop, you could see coffee prices go up to 300.
I'm worried about that one.
Well, this is just a made-up scenario.
Good.
But if we did see coffee prices go up 300%, we don't want the central bank adjusting policy based on that temporary disruption to an isolated component of the market. And that's what the Fed thought we were dealing with here, a temporary or transitory disruption that didn't warrant a long-term policy move. But by the end of last year, it became very clear that price pressures were becoming more broad-based, more seeping into other sectors of the economy. We saw labor costs begin to increase rapidly, and the Fed quickly changed its tune, but arguably too late.
Now, as an economist, I'm sure you've heard the old line that economists have predicted 12 of the last 6 recessions. Yes. I'm hearing more certainty this time.
Well, I think it's a little easier this time around to predict the recession when we've already had back-to-back quarters of negative growth, which is traditionally the layman's definition of a recession.
Does it matter if we are in a recession?
I don't think it does. As I mentioned, you're just talking about a technical classification or characterization of the downturn. For everyone sitting in this room, for your clients, for us as consumers and business owners, again, it doesn't matter what we call it. It's a question of how long and how deep is the negative growth going to be, is the downturn going to be? And that's the bigger question. I think it really is inconsequential of whether or not we call it a technical recession or a downturn.
So let me ask you the same question we asked yesterday. How can the Fed battle this? I mean, historically, interest rates have to get up where inflation is in order to calm things down.
Right.
All right, and the Fed's trying to get interest rates up, and Congress keeps throwing money out there like drunken sailors and they're buying, or not buying votes, but they're taking care, I shouldn't have said, they're taking care of those hardship citizens that we have that
Yes.
are sitting at home with new TVs and cars. But how do you fix that? I mean, how in the world can the Fed raise rates fast enough when Congress keeps pouring money into the economy?
Well, our fiscal policy leaders are certainly making it more challenging for the monetary policy side to rein in inflation. As you mentioned, as we continue to see this fiscal stimulus flood into the marketplace, that will have the opposite impact on inflation. The Fed is trying to bring down inflation, expanding the money supply accelerates price pressures. Now, it's the latest initiatives are nowhere near the size of the $6 trillion relative to what we saw during COVID. So that's maybe a silver lining. We're taking a step in the right direction of reducing the fiscal stimulus. But you're right, it's causing more of a challenge for the Fed and more of a psychological impact for many of these workers that are sitting on the sideline because they are convinced that more fiscal dollars are coming down the pipeline. Why would I go back into the labor market if I'm anticipating another round of support while I can still be outside the traditional labor market?
Well, which brings up the question of the COVID crisis. Mm-hmm. We, in essence, threw, what, $7 trillion in a $2 trillion hole, right? I mean, we had so much more money out there than we needed in order to keep things going. That $5 trillion or whatever, $6 trillion, whatever it is, that's dissipating quickly. You think that that's going to dissipate quickly enough to help this inflation and this wage increase and all these things that are just pushing us out the door?
Well, I think we're already seeing signs of improvement or less impact from the savings. We're already seeing consumers cut back. We're still spending, but we're spending at a slower pace. Wages are still elevated, but that growth, that level of growth is moderating at around that 5% level. We are hearing anecdotally from businesses that at least more resumes are coming across their desk. There is pulling in some individuals, not in droves, but we are seeing some improvement. But we also have to remember that it's not just about the $6 trillion in savings. Consumers didn't have to resort to credit cards during the past 2 years. In fact, many individuals paid down debt levels. And so going forward, even as savings evaporates, we have a good amount of debt accumulation that the American public is going to be willing to accumulate before they feel this sense of immediacy to return to the labor market and establish a more steady stream of income. Now, debt levels have increased by about $300 billion, but when we look at this as relative to personal disposable income, we're actually at historic lows. So the average American household is pretty healthy right now, meaning we have the capacity to take on a good amount of debt via credit cards or liens against our home, et cetera, to supplement that loss of traditional income for the next several months, maybe longer.
So does that, and I'll get off this subject, but this is the job market the same for those people that left the job market? Are they coming back into artificial intelligence taking over their job? Are they coming back into robotics? Is it the training? We're going to have a huge deficit in training and job skills. The immigration issue on some of the just basic blue collar labor. Where are these people going to find jobs? I know that everybody's advertising for them.
Right. Well, I think you're speaking to a bigger issue that we were seeing even before the pandemic, something that we've dubbed the skills mismatch. Because remember, there wasn't zero vacancies in the labor market prior to COVID. There were just markedly fewer. But there was a concern prior to COVID, talking to many businesses, that they would get maybe 10, 20, 30 resumes coming across their desk for one job opening, which is better from a numbers standpoint. But these individuals didn't have the skills needed to fill that job vacancies. They didn't have the math skills, the coding skills, the technology skills, the engineering skills. And so I think to your point, we are already facing a sizable deficit when it comes to training and educating the workforce and the future generations that are coming out into the marketplace. Now, of course, we do have a little more of a focus on STEM, but that only came about maybe 10, 12 years ago. So we still have a number of workers in the labor force or sitting on the sideline that we would prefer to be in the labor force that don't have the skills to fill those vacancies. So that's another crisis that we do need to contend with on top of the lack of incentive for workers to come back in as a result of the COVID policies.
So more money.
It could mean more money depending on what state you reside in.
One of the data points that I didn't hear you discuss, and maybe I missed it, was the relative strength of the dollar, the historic strength of the dollar versus other world currencies.
Yeah.
How does this play into the current analysis?
Well, if you are a multinational business, a strong dollar is going to make it a little more difficult for you to benefit from overseas activity. So I think when we're talking about the currency market, we have to remember it's always relative. There's going to be winners and there's going to be losers. But certainly long term, when we talk about this from a perspective of purchasing power, we want a strong dollar. We want a strong greenback to maintain our individual ability to go out into the marketplace and buy the same amount of goods and services this year as we did prior. But of course, at this point, when we're trying to control inflation, when we're looking at a national debt that's just escalated beyond words, a strong dollar does complicate that process.
Does it attract more capital to the U.S.?
I think it attracts more capital, as well as the fact that even as we complain about potentially falling into a recession, the U.S. economy, broadly speaking, even independent of the strength of the currency, is still sitting as what I would deem the prettiest girl in the ugly girl contest. So we're still going to be absorbing
I'm glad you use that analogy.
There's a few of us that, yes, don't use that. But we're still absorbing those positive capital flows as we look at what our European counterparts and our other developed counterparts around the world are facing, very sluggish growth levels versus the modest growth decline that we're seeing here against the backdrop of one of the largest, most liquid markets, one of the most entrepreneurial labor forces, and still a very strong currency.
I'll throw two questions to you at once. Do you think the Fed has the backbone to actually stop inflation, and how high will the rates have to go?
I think the Fed has the backbone to maintain the rhetoric that they're focused on inflation. But to get inflation fully under control, it is almost out of their control.
Because of the supply chain.
Exactly. Monetary policy cannot address international policy overseas. Yeah. And so I think at this point, what the Fed is going to do is raise rates to a point that we've clearly dampened demand. Demand-side inflation metrics have come under control. The economy is slowing precipitously, whether or not we're in technical recession, and hold rates steady at that level.
Are you seeing like maybe another 150 basis points total?
I don't think it's out of the realm of possibilities that we get up nearer 5%. On Fed funds, if inflation remains out of control.
We're anticipating 75 tomorrow. Mm-hmm. Do you think there's a surprise there?
Not tomorrow, no. I don't think the Fed has any incentive to shock the market. In fact, the Fed is increasingly willing to capitulate to market expectations. So if, in fact, the latest inflation report had been cooler than expected, and we're talking about tenths of a percentage point, which in normal times should not sway market expectations. But in today's market, it is enough. And if we had seen a cooler inflation report and the market went back to 50 beeps, I think the Fed would have capitulated and downgraded to 50 basis points.
So what happens if they, well, like they have done in the past, capitulate too early? We end up in I guess the double dip economy or whatever you want to call it, and we end up skyrocketing it again.
Well, let me clarify. I don't think the Fed would capitulate to the idea of stopping rate increases at this point. But I do think they're willing to be flexible on the size of rate increases. So if the market seems to become a bit more optimistic that we're nearing that end level, they would be more inclined to go to 50 or back to 25, but still continuing to raise rates until we see a meaningful retreat in prices, which of course, to your point, we may not see for years. So reaching that terminal level, we might be there for quite some time.
Well, I mean, it seems that way. We're in a demand pull, right? Right now.
Correct.
And we all know we can't get to the supply pool. It's difficult. I mean, and it's not in our hands, as you say, really.
Right.
So this is a game that's just going to have to play out for quite a while before we come to some conclusion.
It will. And again, it comes back to your point. There's two types of inflation: demand pull or cost push. Now, inflation, by any name to us sitting in this room, is elevated prices. But the concern for the Fed is when we see the traditional demand pull, that leads to higher costs because we have too many dollars chasing too few goods, and that leads to an expansion of the economy. On the flip side, the cost push leads to a reduction in the economy. So that's why it's so important that we understand the different drivers of inflation. And at this point, we have both, with arguably the supply side, or that cost push, leading the way.
One of the things you said in your presentation was we have negative growth, but we're raising rates.
Yes.
Are we in uncharted territory?
It does appear that way because typically, as I mentioned, in historical cycles, the Fed is raising rates when the economy is expanding, arguably when the economy is overheating. As I mentioned, we see that traditional demand pull inflation. That's leading to an expansion of the economy. Consumers are spending too much. We're not buying 2 big screen TVs. We're buying 3. And the Fed says, wait a minute, we need to slow demand. We need to slow the economy before we get out of control. That's when the Fed traditionally raises rates. But this time around, yes, consumers are still spending. They're still maybe buying that big screen TV after cutting back for 3 months. But overall growth is already in negative territory. Now, one caveat I should throw out there, and part of the reason that we are debating this technical versus non-technical recession so greatly is because, yes, we did see headline growth fall negative at the start of the year and in the second quarter, but at the start of the year, that was predominantly driven by inventories and the idea that businesses were trying to navigate this new environment of hoarding parts and materials when they became available. But as demand shifted, not only were businesses sitting on maybe less desirable goods, but only partially producible goods. They only had certain parts. And so when we strip out the implications of inventory and trade at the start of the year, arguably a transitory, maybe temporary impact on growth, GDP was up over 2%, positive up over 2%. So that complicates the picture for the NBER, or the committee that officially determines recession. So that's part of the reason why the conversation is so nuanced at this point, because we do have such unprecedented factors impacting the economy.
So we're getting to some subjective as opposed to objective judgments.
Absolutely, and a lot of economics is. There's a lot of psychology in economics.
When's the Fed ever been different? I mean, they've never gotten it right at the right time.
Well, to be fair, the Fed, however, historically has been anticipatory in their policy. They begin to slow rate increases or even stop rate increases in anticipation of inflation behaving, of inflation coming down. This time around, the Fed said, no, we are not going to do that. We are going to wait until inflation shows us that it's coming down. And so arguably, this time around, the Fed will tighten beyond what is necessary because they're not being patient, not allowing the impact of earlier policy decisions to fully infiltrate the market. And that's, I believe, why the market is anticipating that the Fed quickly reverses course and actually begins to cut rates by the end of next year.
So I'm going to do what John did. I'm going to ask 2 questions at once to get way ahead of everybody here. We're not in a Volcker moment, you don't think?
No, I don't, because one, the Fed has taken a clear communicative position of their intentions of reining in that inflation dragon. One of the mistakes that we saw during the 70s is the lack of communication. And the Fed wasn't clear about how committed they were to reining in inflation. And remember, inflation expectations began to become unanchored. This time around, the Fed has been very clear. We're going to raise. We're going to cause a lot of pain for the American public. and inflation expectations have been well controlled. And so I don't think we're going to see the need for the Fed to do that volatility, that start and stop, as we saw during the 1970s.
Okay, now the second half of that
Yeah.
is, remember, you're in a room full of bankers here when I ask
Absolutely.
this question. I'm going to ask you to dip your toe in the political realm. You've got Bloomberg at the FDIC, who is now saying we need to raise assessments because of the deposits that were thrown in there during the PPP program. And those are running off like crazy. As you said, 95% of that's gone off, and it's continuing to run off.
Right.
Would you say he's way early in doing that, or is something that needs to be done?
I would say, let me say it this way. There's always unintended consequences of these extreme policy measures that we take during these unprecedented times. Now, to be fair, fiscal policy members and monetary policy makers were looking at unprecedented conditions. They didn't know exactly what was happening. We didn't know what was happening. A lot of these policies were just thrown at the wall to see what stuck, to just try and get us through the worst of it. And so now in the aftermath, we do need to take a more clear-headed look at the implications and how to maybe walk back some of those implications from the policy measures. That's my very politically correct way of not addressing your question.
I don't think I'm still trying to figure out what the answer was.
One of our speakers yesterday was talking about political economics. What effect do you see the midterm elections having on where we are economically?
Well, I think it's the direction of the challenge that fiscal policy is going to place in front of monetary policy. Going back to what we talked about earlier, if we do see Democrats increase power, then it's more likely that we see a growth in fiscal initiatives, more stimulus, more support for those in a position of hardship, maybe additional incentives to remain outside the labor force. However, if power is shifted more to the Republican side, I would anticipate less of those measures. More fiscal conservatism to come back into place, less fiscal stimulus. So it's a very strict, a very clear dichotomy in terms of policy initiatives. And the Fed obviously is autonomous. They're not supporting one side or the other, but certainly the Fed would like a more clear-cut pathway with less obstacles to reinstate price stability.
So is that the same thing the market would like to see?
I think that the market anticipates that it's going to be a challenge for the Fed to bring down prices to a level.
Again.
Yes, I am. I'm very good at it. But I do think that the market wants to see the end to restrictive monetary policy sooner than later. And so the less challenges that they face from a fiscal standpoint, the better for the market.
Dr. Pieza, thank you so much for being with us. And
Thank you.
there will be a quiz later this morning. Just, if you didn't take all that in, thank you.
Thank you. Thank you for having me.
Wonderful. Enjoy it.